Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Another trade that I would look at when I'm trying to avert disaster, and again, this is not a popular one right now because the butterfly, which you're looking for, the butterfly option strategy is that you're looking for the market to stay in a certain range. So you buy, in, let's say, calls or puts, you buy one strike, then the next strike you sell twice as many, and then you buy the next strike up, you buy one more, and you hope that the underlier goes out right at the strike price. And I'll give you some examples on all of these. But the most you can lose is a debit. The worst case scenario is that you lose your debit because the underlier moves far away. So let's look at the examples. I hope that you're all finding this very useful because, again, normally we'd have Rob Booker here today, but Rob is sick, so he couldn't make it. So instead of canceling, which I would never want to cancel, I said, what the heck, I'll do this as I present option seminars all throughout the country each and every week. As part of my responsibility at the ISE, I said, all right, I'll do an options presentation. So I hope you're finding this very useful. And the theme here is to try to avert disaster in trading in a very volatile market. So let's say, and there's a couple different strategies. One would be that I'm bullish on the U.S. dollar. And again, I took these prices. I did this just in the afternoon, so pretty close to where it closed. Again, I think it closed at 110.78. I have the price at 110.60, so they're going to be pretty close in case any of these look really good. I'm not recommending these strategies at all. These are just examples, but they're pretty close. So buying a 3-month 113 call for $1.81, how much could I lose? Well, the best part about this trade is that I could only lose my $1.81. Let's just say that I think, for whatever reason, that there's going to be more hedge fund liquidation of the Canadian dollar, that the U.S. dollar, there are more people who need to buy the U.S. dollar back in the next week, and that the U.S., let's just pick a number. Let's just say that, I know it may sound crazy, but we think that the U.S. dollar versus the Canadian dollar could get to 116 for whatever reason. Well, if that's the case, then buying the 113 call for $1.81 probably makes sense because we know if it gets to 116 or beyond, that option is going to be worth $3. I only paid $1.81 for it. And you're thinking, well, why would I do that if I can only make $1.19 to risk $1.81? Well, it may go way beyond 116, and also I have limited risk here. So if I'm wrong, I can only lose $1.81. I can actually make way more than $1.19. Another strategy, this would be the opposite strategy. So I'm looking for something that I would benefit if I thought maybe I'm a U.S. citizen or maybe I just think that the U.S. dollar it's going down. What do? Well, I could just quite simply buy a 3-month 107 put. Remember, last November, the U.S. dollar against the Canadian dollar is trading around 91.92. Now, you could buy the 107 put for $1.23. So if it gets to 92 again, it'd be worth 15. I'm not trying to say that it's going to be going to 92, but just think of the risk reward if you believe that the U.S. dollar is going to top out very soon. This would make sense. If you don't think the U.S. dollar is going to top out very soon, it would not make sense. So you buy the 3-month option. Your break even at expiration would be 107 minus 123, or that break even of 104.77. If the U.S. dollar does not move, the investor will lose their entire investment. So how about some alternative strategies? How about spreading? Again, we're in this very volatile market, trying to avert disaster. Bull call spreads, well, I just did 2 or 3. I actually did 3. I did the 104, 110, the 107, 113, and the 110, 116. So I looked at the prices as of about 2 o'clock, 2:30, a couple hours ago, Eastern Time. The in-the-money option is 410, was 410. Now, why is it the most expensive? Well, it's the most expensive because it has the highest probability of success. So I'd rather pay more for that one than pay for, let's say, the 107, 113, because my rights are better. I have the right to own it at 104. Of course, I'm giving somebody else the right to own it at 110. So that spread, the maximum it could ever be worth is $6. So I pay $4.10, I could risk $1.90, and if it stays right here at 110, I make my $1.90. So some of us could say, well, that's a great trade, but some of us could say that's a terrible trade because I'm actually risking 2 to make 1, or 10 actually to make $1.90. So it depends on the way how you look at risk reward. The second example would be 107, 113. It's basically an even risk reward, and again, you know, we're pretty much in between the two strike prices. So risking 304 to make 296. If nothing happens, I actually make a little bit of money. If I buy the spread that has the most leverage, well, if I buy more leverage, nothing happens. I lose most of my investment. So if I could put up $1.97, nothing happens, well, then I lose $1.37. So that's really, in a nutshell, how options work. So for those of you that have not traded spreads, I think that you're going to find this fascinating, the idea that you can create your own risk reward. You can find the one spread or two spreads that you like and either buy or sell it. Those are call spreads. If you were bearish and you wanted to do, those are debit spreads too. If you were bearish, you'd be doing the reverse. You'd be buying put spreads. So I could look to do, let's say, the 104, 110 if I think the U.S. dollar is going to weaken. Let's say I thought it was going to get down to 104-ish. Well, I'd be happy to do this 104, 110 where I'm risking $1.84 to make 416. But if nothing happens, I lose my entire investment. Alternatively, if I look at the most expensive spread, then it would be buying the 110, 116 where I'm risking about $4, actually $3.98. I can only make 202. But if nothing happens, I make $1.42. And the more moderate of the three spreads is buying the 107, 113, where I'm buying the 113 put and selling the 107, and I'm risking 287 to make 313. So more of a balanced approach there. And if unchanged, I lose about 47 cents. It's all the prices, though. So again, you can understand options. It's great to understand options. In fact, it's paramount to understand what options are, to understand the risk-reward of options. Also, you want to understand a little bit about the option Greeks, how the delta works. And you also want to understand active management. But at the end of the day, it's going to be about where you think this asset's moving. The theoretical viewpoint is that it's going to be unchanged. We know that that's nice in theory, but we know the model may have some flaws, and that's some of the problem there. Is the model isn't always going to be right.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.